In 2025, the U.S. economy is at a crucial moment. After a long period of uncertainty, with inflation as a constant threat, the evolution of the economic landscape is being influenced by unforeseen global changes. Government cuts, shrouded in uncertainty, could be the turning point that redefines what's to come economically. The current challenges are much deeper than they appear. The U.S. economy has moved past the days of explosive growth. With GDP growing at only 2.5%, we're seeing a natural slowdown after years of massive stimulus. The days of economic booms are over, and now we're entering a phase of calmer normality, where growth is more moderate, but still present. This cooling down isn't necessarily a bad thing. It's a correction after the pandemic boom, with the economy adjusting to a more sustainable pace. However, this isn't a dull year. Some industries are innovating on a large scale, ready to take off, while others could fall behind, struggling to adapt to the new landscape. One of the major problems still shaping the economy in 2025 is inflation. Although it's not at the extreme peaks of 2022, it remains a significant challenge. In simple terms, inflation is the widespread increase in prices, meaning that the money you have today doesn't buy as much as it used to. And in 2025, despite the Federal Reserve's efforts to control it, inflation remains above the target of around 2%, hovering between 4% and 5%. This level of inflation has direct consequences on daily life. Although we're not seeing the sharp increases of previous years, the prices of basic goods, like food, gasoline, and housing, continue to rise. This causes consumers' purchasing power to diminish, especially affecting those with fixed incomes. Additionally, businesses are facing higher production costs, which may translate into higher prices for consumers. But are the Federal Reserve's measures really correct in the long run? In 2025, the Trump administration continues to pressure the Federal Reserve to lower interest rates in order to boost economic growth. The idea behind this strategy is simple. By making credit cheaper, consumers and businesses are expected to spend more, which should help reactivate the economy. However, lower interest rates also come with risks. The Federal Reserve has to carefully balance inflation, which is still above the desired target, and economic growth. If interest rates are reduced too much, inflation could rebound, which in turn would affect consumers' purchasing power. If they remain high for too long, growth could be stifled. Opposition to these policies argues that efforts to lower interest rates could have negative long-term effects. Critics point out that these measures could weaken the Federal Reserve's independence, as political intervention may make the Fed's decisions appear less objective. Additionally, there is concern that this approach could create an economic bubble that might eventually burst. Meanwhile, the U.S. labor market in 2025 presents an intriguing picture. Despite the economic slowdown and persistent inflation, the unemployment rate remains surprisingly low. But is this resilience a sign of real strength, or merely a mirage of temporary stability? Employment figures continue to show positive results, with many companies reporting a steady demand for labor, particularly in sectors like technology, healthcare, and logistics. However, analysts are beginning to question whether this stability can be maintained given the current geopolitical and economic situation. Wages are rising, yes, but not at the same pace as prices. As a result, workers feel that their incomes no longer stretch as far as before, leading to growing discontent. Is this a sign of a labor market adjusting, or a warning that businesses are being forced to maintain hiring just to survive? Despite the low unemployment rate, working hours are starting to decline, and many companies are turning to automation to reduce costs. This shift raises a question. Is the resilience of the labor market a sustainable phenomenon, or just a phase before a deeper correction? The reality is complex. While some sectors are thriving, others are feeling the pressure. The U.S. workforce is struggling to adapt to an economy that is being redefined. And although the unemployment rate may seem low, the true health of the labor market may be far more fragile than it appears. In this scenario, resilience might be slowly unraveling, even if we don't see it yet. Likewise, the U.S. real estate market in 2025 is beginning to show unmistakable signs of a slowdown. After years of rapid growth driven by historically low interest rates and intense demand for property, the momentum has shifted. With interest rates now significantly higher and inflation weighing on household budgets, buyers are pulling back, especially in the single-family and luxury housing segments. Prices, which once seemed to only go up, are now stabilizing or even declining in some regions. But this cooling isn't evenly distributed. While certain cities and states are seeing noticeable drops in home prices and sales activity, others, particularly those with tight housing supply, continue to show resilience. However, even in those areas, the sense of urgency among buyers has faded. Economic uncertainty has made many hesitant to take on large mortgages, and developers are feeling the pinch as new construction slows and inventory begins to sit longer on the market. At the same time, housing supply remains constrained in many metro areas due to years of underbuilding. This could act as a cushion against a sharp crash in prices, but it also means affordability continues to be a major issue for many Americans. The question hanging over the market is whether this is just a healthy correction after an overheated cycle or the beginning of a more significant shift in the housing landscape. The forces at play, rising rates, stubborn inflation, cautious buyers, and uneven regional trends, suggest a complex, fragile balance. For now, the real estate market stands at a crossroads, quietly transitioning into something new. Whether that something brings stability or signals deeper cracks remains to be seen. At the same time, in 2025, the trade war between the United States and China has entered a new, more complex and strategic phase. Far from cooling down, the economic conflict between the two powers continues to escalate, with new restrictions, tech controls, and protectionist policies. While some U.S. industries are being shielded, others are already feeling the pressure. Measures imposed by the Trump administration, such as restrictions on Chinese investments, export bans on advanced technologies, and new targeted tariffs, aim to strengthen domestic production and reduce dependence on China in key areas like semiconductors, artificial intelligence, and critical manufacturing. The official narrative centers on economic security, but the economic cost is real. Companies reliant on global supply chains are facing rising costs and logistical delays. Meanwhile, consumers are seeing price increases on electronics, machinery, and imported consumer goods. At the same time, China is responding with its own restrictions, hitting back at U.S. agricultural and tech sectors. The conflict is no longer just about trade. It's a race for global economic and technological dominance. And in the middle of this standoff, the U.S. economy is walking a fine line between strategic protection and the risk of deeper economic fragmentation. Also, in 2025, concerns about the future of the US dollar and the ballooning national debt are becoming increasingly difficult to ignore. With the federal debt surpassing $35 trillion, questions are emerging not just about sustainability, but about long-term credibility. Despite the dollar's continued dominance as the world's reserve currency, cracks are beginning to show in the foundation. The growing debt has sparked debates about fiscal responsibility, especially as interest payments consume a larger share of the federal budget. This limits the government's flexibility to respond to new crises or invest in strategic areas like infrastructure and innovation. Critics argue that if the U.S. continues along this path, it risks weakening investor confidence and triggering long-term inflationary pressure. At the same time, several countries, led by China and Russia, are exploring alternatives to the dollar for international trade, pushing for regional currencies or digital alternatives. While the dollar remains strong for now, its supremacy is no longer unquestioned. As the U.S. walks a tightrope between maintaining global financial leadership and managing its growing debt load, the future of the dollar may depend less on its past strength and more on the tough decisions made in the years ahead. Finally, the stock market in 2025 finds itself in a particularly uncertain moment. After years of volatility driven by the pandemic, inflation, and geopolitical turbulence, investors are more cautious than ever. While the S&P 500 and other indices have shown some stability, the confidence that once fueled the bull market is no longer what it used to be. The Federal Reserve, with its interest rate decisions, remains one of the most closely watched forces on Wall Street. Every statement has the potential to shift markets in an environment where liquidity is tighter and capital more selective. On top of that, the ongoing trade war with China has already impacted key sectors like technology, manufacturing, and consumer goods. Yet there are still pockets of optimism. Artificial intelligence, the energy transition, and certain industrial sectors are attracting investment, with the promise of a new wave of growth. But the question remains, is this a genuine recovery or the early stages of a bubble? Investors are navigating a fragile market full of both promise and warning signs. In 2025, the real challenge isn't just predicting where the market will go, but understanding what's truly holding it up. In summary, in 2025, the U.S. economy is at a critical juncture. Growth is slowing, inflation persists, and the Federal Reserve's decisions raise questions about their long-term effectiveness. The labor market holds steady, but with signs of vulnerability. The housing market shows signs of cooling, while national debt continues to rise. On a global scale, the trade war with China adds uncertainty to an already volatile landscape. While the stock market appears stable, the forces keeping it up are uncertain. Everything seems calm, but the future holds hidden mysteries.